The Intelligent Investor by Benjamin Graham is often referred to as the Bible of value investing. First published in 1949, this seminal work has guided countless investors through the complexities of the stock market. Graham's philosophy of value investing, buying undervalued stocks and holding them for the long term, has stood the test of time. His teachings emphasize the importance of thorough research, patience, and a disciplined approach to investing. This book is still incredibly relevant today, even in our fast-paced, technology-driven world. The principles laid out by Graham are timeless and can be applied to any market condition, whether you're dealing with a bull market or a bear market. By following the strategies in The Intelligent Investor, you can build substantial wealth over time. It's not about making quick profits, but about making smart, informed decisions that will pay off in the long run. Graham's principles are truly timeless. They have been proven to work in any market condition, from the Great Depression to the modern-day financial crises. His emphasis on margin of safety and intrinsic value provides a solid foundation for any investor. This book is not about getting rich quick. Instead, it teaches you the importance of a slow and steady approach to investing. It's about making well-researched, informed decisions and having the patience to see them through. One of the key lessons from The Intelligent Investor is to think like an owner. When you buy a stock, you're not just buying a piece of paper, you're buying a part of a business. This mindset shift can make a huge difference in how you approach investing. You'll learn how to analyze businesses in depth, understanding their financial statements, management quality, and competitive advantages. This analytical approach helps you make more informed investment decisions. You'll also learn to identify undervalued stocks, those that are trading for less than their intrinsic value. This skill is crucial for any value investor and can lead to significant gains over time. Ultimately, The Intelligent Investor is your key to long-term success in the stock market. By following Graham's principles, you can navigate the complexities of investing with confidence and achieve your financial goals. Benjamin Graham was a Wall Street legend. Known for his profound impact on the world of finance, Graham's principles have stood the test of time and continue to influence investors today. His journey began in the late 19th century, a time when the financial world was vastly different from what we know now. He was born in 1894 in a world that was on the brink of massive industrial and economic change. Growing up in New York City, Graham witnessed firsthand the bustling energy of a city that was rapidly becoming the financial capital of the world. Graham is considered the father of value investing, a strategy that focuses on identifying undervalued stocks. His teachings emphasize the importance of thorough analysis and a disciplined approach to investing. He believed that by understanding the true value of a company, investors could make more informed decisions. He started his career on Wall Street in 1914, a time when the stock market was still in its infancy. Despite the challenges of the era, Graham quickly made a name for himself with his keen analytical skills and innovative investment strategies. He later became a professor at Columbia Business School, where he shared his knowledge and insights with a new generation of investors. His classes were highly sought after, and his students included some of the most successful investors of the 20th century. Graham believed in buying stocks below their intrinsic value, a concept that was revolutionary at the time. He argued that by purchasing undervalued stocks, investors could minimize their risk and maximize their potential returns. This approach laid the foundation for modern value investing. He taught his students to look for a margin of safety, a principle that has become a cornerstone of value investing. By ensuring that there is a significant difference between a stock's market price and its intrinsic value, investors can protect themselves against potential losses. His most famous student was Warren Buffett, who has often credited Graham for shaping his investment philosophy. Buffett's success is a testament to the enduring power of Graham's principles. Buffett credits Graham for his success, often referring to him as his mentor and the greatest influence on his career. Through Buffett and countless other investors, Benjamin Graham's legacy continues to thrive, proving that his timeless wisdom is as relevant today as it was over a century ago. Graham distinguished between investing and speculation. Investing is about owning a piece of a business. You analyze the business. You look for long-term growth. Speculation is about trying to predict the market. Speculators chase hot stocks. They buy on rumors. They sell on fear. Don't be a speculator. Be an investor. Invest in quality businesses. Hold them for the long term. Intrinsic value is the true worth of a business. It is not the stock price. The stock price can fluctuate. Intrinsic value is based on the company's assets. It is also based on its earnings potential. To calculate intrinsic value, you need to analyze the company. Look at its financial statements. Consider its industry position. Think about its management team. This will help you determine the true value. The margin of safety is the difference between the stock price and its intrinsic value. This concept is crucial for investors who want to minimize risk and maximize returns. By understanding and applying the margin of safety, you can make more informed decisions and protect your investments from unforeseen market fluctuations. Essentially, it acts as a buffer, ensuring that even if the market takes a downturn, your investments remain relatively secure. Buy stocks trading below their intrinsic value. This means you are purchasing shares at a price lower than what they are actually worth. When you buy undervalued stocks, you are essentially getting a bargain. This strategy not only provides a safety net but also positions you for potential gains when the market corrects itself and the stock price rises to its true value. This provides a cushion for your investment. Think of it as a financial safety net that absorbs shocks from market volatility. When you have a margin of safety, you are less likely to experience significant losses because you have already accounted for potential risks. This cushion allows you to invest with greater confidence and peace of mind. It protects you from losses. In a volatile market, prices can swing dramatically. Having a margin of safety means that even if the stock price drops, you are still above your purchase price, thereby minimizing your losses. This protection is invaluable, especially during economic downturns or unexpected market events. A larger margin of safety is always better. The bigger the gap between the stock price and its intrinsic value, the more protected you are. A substantial margin of safety not only reduces risk, but also increases the potential for higher returns. It's like having a larger buffer zone that shields you from market unpredictability. It gives you more room for error. No one can predict the market with absolute certainty. By having a significant margin of safety, you allow yourself some leeway for mistakes or miscalculations. This room for error can be the difference between a successful investment and a financial setback. It also increases your potential upside. When you buy stocks at a lower price, the potential for profit is much higher. As the stock price rises to meet its intrinsic value, your returns can be substantial. This upside potential is one of the key benefits of investing with a margin of safety. Aim for a margin of safety of at least 30%. This percentage provides a comfortable buffer that can protect you from market volatility and unforeseen events. A 30% margin of safety is a good rule of thumb for conservative investors who prioritize security and long-term growth. This will help you sleep well at night. Knowing that your investments are protected by a substantial margin of safety can give you peace of mind. You can rest easy, confident that you have taken the necessary steps to safeguard your financial future. Mr. Market is an allegory created by Graham. He represents the stock market. Mr. Market is emotionally unstable. He offers to buy or sell stocks every day. His prices are often irrational. Don't let Mr. Market dictate your decisions. Take advantage of his mood swings. Buy from him when he's fearful. Sell to him when he's greedy. Remember, you are in control of your investments. Graham identifies two types of investors: defensive and enterprising. Defensive investors seek stability. They invest in low-risk assets. Enterprising investors are more active. They seek higher returns. Defensive investors should focus on index funds. They can also invest in blue-chip stocks. Enterprising investors can consider individual stocks. They need to do their research. Choose the approach that suits your risk tolerance. A defensive portfolio aims for steady growth. It should be well diversified. Start by investing in a low-cost index fund. This will give you exposure to the entire market. Next, add some blue-chip stocks. These are large, stable companies. They have a history of paying dividends. Consider adding bonds to your portfolio. Bonds are less risky than stocks. They provide income. Enterprising investors look for bargains. They analyze companies in depth. They look for hidden value. This requires time and effort. It also requires a deep understanding of finance. Enterprising investors should focus on undervalued stocks. Look for companies with strong fundamentals. They should be trading below their intrinsic value. Be patient. These opportunities don't come often.